Hello friends, I welcome you to a presentation on INDAS 106. In this presentation we are going to talk about INDAS 106, which corresponds to IFRS 106, and in this standard we are going to talk about how to deal with financial reporting for exploration and evaluation of mineral resources. So an activity called as exploration and evaluation of mineral resources, expenditure relating to that activity, how is it going to be reported in our financial statement is what we are going to discuss in this lecture. Okay. Now here we have a picture here, we have a drilling ship. Now the job of this drilling ship is to go into the deep oceans. There is a drilling equipment attached to the ship, and with the help of this drilling equipment, this ship is going to, we can say, drill some holes in the seabed, and it will search for oil or gas or for other mineral resources. Now it will do drilling in a specified earmarked area for which we have a license to explore for, and then in that area we can explore. It will dig maybe 3 or 4 wells in that area. I am not specifying the number. It can dig many wells, and it will search for oil. Okay, and it will study what is the quantity of oil available, what is the quality, etc. And once that study is over, the oil company would be establishing a deep sea oil rig, which will be stationary. This is floating, that will be stationary, and then they will start extracting oil. Okay, so expenditure incurred on this exploration activity which is being carried on, how to deal with that expenditure is what we are going to learn, how to do accounting for that expenditure. Okay, now exploration and evaluation expenditure. So what we are talking about here is exploration and evaluation. What do you mean by exploration and evaluation? This is an activity carried out by a company which is doing business in extractive industries. That means they are into business for exploration for oil, gas, minerals, other non-regenerative resources. They will explore, and once they find, they will acquire that resource, and then they will start developing the mine to remove that resource from the mine. Okay, so this is the business. So what is exploration and evaluation? We are talking about exploring, that means searching for oil, gas, minerals or other non-regenerative natural resources. Evaluation means we have to evaluate whether it is technically possible to remove oil from the seabed, from the resource which we have found. Is it technically possible to extract coal? So we are trying to determine whether it is technically possible and commercially possible to take out those resources. Okay, so that is exploration and evaluation. Expenditure incurred in that activity is considered as exploration and evaluation expenditure. Okay. Now, before I go into this question, we have to first of all understand a point that we can start searching for oil, gas or any other mineral resource only once we get a license. We have the right to start exploring. So we have to acquire the right to explore, and then we start searching for oil. And there will come a day when I can demonstrate that technically it is possible to remove that, we can say, oil, gas or resources, and commercially also it is viable. That means it is profitable. So between these two dates, whatever activity goes on is called as exploration and evaluation. Expenditure which is incurred during this period, that is the day you have received the license, you start your exploration activity, and the day you are able to demonstrate technical and commercial viability, or till that day whatever expenditure is incurred is what is going to be discussed in the standard, how to do accounting for that. Now expenditure incurred during this period, there can be only two possible accounting treatments for any expenditure. Either you are going to expense it, that means you are going to debit to P&L account, or second is capitalize them, that means treat them as an asset. So which of the options you are going to adopt is what we are going to have more clarity about in this standard. Okay. Next, is there any specific standard? The answer is no, there is no specific standard before INDAS 106 was issued or before IFRS 106 was issued. Okay, IFRS 6 was issued. IFRS 6 corresponds to INDAS 106. Okay. Now, this issue is scoped out of INDAS 38. INDAS 38 deals with intangible assets. INDAS 38 specifically scopes out exploration and evaluation expenditure. INDAS 16 does not apply to mineral rights, mineral reserve, expenditure incurred on exploration and evaluation. And we can say there is no specific standard which dealt with this before INDAS 106 talked about it. Okay. Even today there is no standard in deciding what accounting policy to be followed. INDAS 106 has a restricted scope, we'll come to know when we come into the standard. Okay. this standard only suggests improvement in the current accounting policy being followed. So whatever accounting policy we are following right now for this expenditure, this standard is only going to only give certain suggestions for improvement. Okay, so how to improve those accounting policies is what the objective of the standard is. Okay, so it's not going to decide which accounting policy to be followed. Whichever accounting policy you are following, improvements to that accounting policy is specified in this particular standard. Okay. Now, what is the guidance given by the standard? If, see, the standard says the management, see, this particular area has no specific standard which says you have to do this or you have to do that. No standard says that you have to either expense it or you have to treat it as an asset. So when you don't have a specific accounting standard, Indian accounting standard dealing with a particular accounting issue, in such cases we refer to INDAS 8. And INDAS 8 says whenever you are selecting an accounting policy for an area where there is no INDAS which has already been issued, in such cases the management has to apply its judgment and it has to develop a standard, it has to develop an accounting policy, not a standard, it has to develop an accounting policy and it has to implement the accounting policy in such a way that the resulting information is reliable and relevant. So again, in the case of exploration, evaluation, expenditure, because there is no specific standard which gives us what are the alternative accounting policies, in such cases management is responsible to apply its judgment and to develop and apply accounting policy consistently so that the information which is generated is both reliable and relevant. So this is what is required. But INDAS 8 says when you are, we can say, developing such an accounting policy, you have to give importance to certain other factors. That means there is a, we can say there are some other documents also which we have to refer. So based on a hierarchy, we have to refer to other pronouncements and then we have to develop an accounting policy. Okay, so that is what INDAS 8 says when there is no accounting policy suggested by an Indian accounting standard for an accounting issue. So the same applies here as well. Okay, so accounting policy choice, the accounting policy has to be made by the management, applying its judgment, it has to be applied consistently. Okay, how to develop that standard? There is certain guidance available in INDAS 8, but there is exemption in the standard, you need not follow that hierarchy. Okay, so let us see. The management of the entity has to develop an accounting policy for such expenditure that results in information which is both relevant and reliable as per INDAS 8. Okay, INDAS 8 requires management to use its judgment and develop an accounting policy that results in information that is relevant and both reliable. Okay. Hierarchy of INDAS 8 for developing an accounting policy. See, INDAS 8 requires you to refer to other pronouncements, other information before you develop an accounting policy. So we have to refer to certain other factors. Requirements of other INDAS dealing with similar issue or related issues. If there are other standards which deal with similar issues, what is the prescription of that standard? It has to be considered for the purpose of developing an accounting policy for an area where there is no accounting policy, where there is no accounting standard. Okay. Management has to consider the requirements of the framework. We have to consider what is the definition of an asset, what is the definition of a liability, recognition principles, measurement principles which are prescribed in the framework. They have to be referred to develop an accounting policy for an area where there is no INDAS. Okay. Then recent pronouncements of the IASB. The IASB has come out with certain recent pronouncements dealing with similar issues, same issues. What are those pronouncements saying that you have to follow? Pronouncements by other accounting bodies which have similar framework of accounting. Next is industry practices which do not conflict with the above, we can say, documents. In such cases, you have to refer to these things while you are developing an accounting policy. Okay. Now, what is the main prescription of the standard? See, before I go into this, what standard says is, whatever accounting policy you are currently following for exploration, evaluation, expenditure, you can continue to follow them. We are only going to suggest certain improvements to the standard, improvements to the accounting policy you are following. And you need not apply all the requirements of INDAS 8. In INDAS 8 para 10, 11 and 12, there are prescriptions regarding how to develop an accounting policy. You have to follow para 10, but you are relaxed from following para 11 and para 12. What is para 11 and para 12? The other documents which you have to refer while developing an accounting policy, like pronouncements of the IASB, recent pronouncements of international accounting bodies, other accounting bodies having the same framework, or we can say INDAS dealing with similar issues, you need not refer to them. That means you have to only develop an accounting policy which results in information which is relevant and reliable. You are given relaxation from para 11 and para 12. Okay. Now what standard saying is, whatever accounting policy you are currently following, you can continue to follow them, but we are going to suggest certain improvements to the accounting policy which you are already applying for exploration and evaluation expenditure. Is it clear? So let us see what the standard has to say. If an entity capitalizes the expenditure and recognizes it as an asset, then standard prescribes. Now see, we have just discussed there can be two situations. One, you treat that expenditure as an asset, or you treat that expenditure to debit it to P&L account. If you debit it to P&L account, there is no headache at all. Okay, we can say most of the standard will become useless for us. But suppose you are already treating exploration and evaluation expenditure as an asset, then there are certain prescriptions from the standard which we have to follow. Okay. Initial recognition. So when you are initially recognizing this expenditure as an asset, at what value should you recognize it? When capitalization should stop. See, you are capitalizing expenditure, you are treating it as an asset. When should capitalization stop? Cease. Third, measurement after recognition. You have already recognized an asset for balance sheet purpose. Subsequently, how do you measure it? Next, classification of the asset as tangible or intangible. You are saying you are going to treat the expenditure as an asset. Whether it should be shown as tangible or intangible. How should it be shown? Next, impairment. What about impairment? So these issues are prescribed only if you treat the expenditure as an asset. Okay. Next, which types of expenses cannot be capitalized? Let us start with this. The standard says, if you are showing exploration and evaluation expenditure as an asset, there are certain expenses which you cannot capitalize. This is the improvement suggested by the standard. Okay. Now, expenditure before acquiring rights to explore cannot be capitalized. Pre-license period, before you got the license to start exploring, if you have incurred any expenditure, that cannot be capitalized. Next, expenditure incurred after technical feasibility and commercial viability are demonstrable. You have come to the stage, you have done a significant amount of exploration studies, evaluation studies, and you have come to a conclusion that it is technically possible, commercially profitable to start extracting oil. Till that date, whatever expenditures incurred can be capitalized. After that date, whatever expenditures incurred cannot be capitalized. Okay. After that date, whatever expenditures incurred, other standard will apply. Okay. Not this standard. Then the result may be positive or negative. So when you demonstrate technical feasibility, commercial viability, it may be a success or it may be a failure. Okay. We are not concerned with that. But standard says, from the day you have acquired the license till the day technical feasibility, commercial viability is demonstrable, till that day whatever expenditure is incurred can be capitalized. Once you are able to demonstrate technical feasibility, commercial viability, cannot capitalize. Is it clear? Cannot capitalize. See, the answer is very simple. If it's a failure, then you have to debit it to P&L account. Entire expenditure has to be debited to P&L account. We call the asset as impaired. If it is successful, then the development activity starts. So whatever expenditure you have incurred on exploration evaluation will also be capitalized as part of the development asset, the mine which is under construction. Okay, it will also be capitalized. You will do some reclassification then. Next, expenditure for development of reserves cannot be capitalized. So if the exploration and evaluation activity was successful and you have now started commercially developing the mining site, you have started installing the rig. So whatever expenditure is incurred for commercially developing that reserve, in such case that expenditure is not capitalized as per the requirement of the standard. It can be capitalized as per the requirements of other standards. Okay. Initial recognition. Now I am incurring some exploration evaluation expenditure. Initially I want to recognize it as an asset. So what is the expenditure can I recognize? Okay. Exploration evaluation asset shall be measured at cost. So whatever expenditure you are incurring, they should be measured at cost only. That means you are not going to adopt the fair value model. Entity should determine accounting policy specifying which expenditure is going to be capitalized. That means we have to clearly lay down which are the expenditure we are going to capitalize as part of exploration and evaluation expenditure. Expenditure associated with finding specific mineral resources can be capitalized. So expenditure is incurred for finding or directly attributable for finding mineral resources can be capitalized. See, administration overheads, general overheads cannot be capitalized if you are not able to establish the fact that it is associated with finding of those specific mineral resources, etc. Okay, so all expenses which you can attribute to the exploration activity, evaluation activity can be capitalized. Okay. Next, example of expenditures which can be included: acquisition of rights to explore, the fees which you have paid to get that license. It is normally an intangible asset. topographical, geological, geochemical, geophysical studies. You are spending some money on doing some research studies. Exploratory drilling expenses. You are exploring the existence of mines, minerals, etc. So you are searching for them, and you are doing some exploratory digging. You are digging small wells to see whether there is oil or not. So whatever expenditure incurred will be trenching. We can say excavating portions of land, sampling. You want to find out what is a earth sample, etc. You take out some samples from the earth to see what is the composition of chemicals, etc. Then activities to evaluate technical feasibility and commercial viability of extraction. So you are doing some scientific study whether it is technically feasible, commercially viable for extraction. So whatever expenditures incurred on these activities can be capitalized. Restoration expenses. See, if you have installed an, we can say, drilling rig for we can say digging wells in the sea, or we can say on earth, on land. In future you are required to remove these rigs and restore that. Okay. Or let us say you are given a right to explore for oil in a desert. You are digging wells, you cannot just leave it like that and come back. Even if you are a failure, you have not been able to find a well with oil, you cannot just remove those rigs and come back. You have to restore that environment as well. So whatever damage you have done, you have to restore. So expenditure incurred would also have to be capitalized. Suppose exploration and evaluation expenditure is debited to P&L account. Our accounting policy is to debit all exploration and evaluation expenditure to P&L account. Then in such cases, this expenditure which has to be incurred in future to restore the environment will also be debited to P&L account. If our accounting policy is to capitalize them, then this future expenses which is going to be incurred in the future, but because of the drilling activity done today, has to be capitalized as part of cost of the we can say asset. Okay, and in future we will pass an entry asset exploration and evaluation asset account to provision for restoration liability. In future, provision for restoration of liability will be used for restoring the environment. Okay. Next, when capitalization should stop. So when should I stop capitalizing the expenditure? After technical feasibility and commercial viability are demonstrable. So the day you are able to demonstrate technical feasibility, commercial viability, you have to stop capitalizing the expenditure. Next, measurement after recognition. The entity should either adopt the cost model or the revaluation model, which is given in INDAS 16 and INDAS 38. See, exploration and evaluation assets can be both tangible and intangible. If you say it is tangible, you will refer to INDAS 16 to see what cost model and revaluation model is as per INDAS 16. If you say it is an intangible asset, then you have to refer to INDAS 36, which deals with INDAS 38, which deals with intangible assets, to see what is the cost model and revaluation model suggested by INDAS 38. So you have to refer to respective standards and apply the cost model or the revaluation model for subsequent reporting purposes. Okay. Again, this will be valid only if you have adopted the accounting policy of capitalizing the expenditure. If you have decided to debit everything to the P&L account whenever it is incurred, then in such cases all these things will be useless for us. Okay. Next, classification of exploration and evaluation asset. See, we are incurring some expenditure and we are saying that we have to capitalize that expenditure as an asset. Should we capitalize it as a tangible asset or an intangible asset is a question that arises. So it depends upon the nature of the asset. If the asset has some physical substance, then it will be tangible. If the asset does not have physical substance, it is intangible in nature, then it will become an intangible asset. It depends upon the nature of the asset. We have some examples here. Drilling rights are intangible. So during the exploration activity, you have acquired some drilling rights, you will show them as intangible assets. Vehicles and drilling rigs which are used, so you are using some vehicles, drilling rigs, ships in your exploration activity, it will be considered as an item of property, plant and equipment, it is considered as tangible. Okay. Next, we will not call it as property, plant and equipment, we will still classify it as tangible exploration and evaluation asset because the standard requires us to disclose it separately from other assets. So we have to maintain a separate classification. We will say intangible exploration and evaluation assets, tangible exploration and evaluation assets. Okay. Depreciation, so if you are using some vehicles, drilling rigs, depreciation on them would be considered as part of cost of an intangible asset. That is the asset which you are developing during the exploration and evaluation phase. Okay. Next, reclassification. Now I want to remove exploration and evaluation assets from my balance sheet and I want to include it as part of a development asset or an asset under construction or a mine under construction, okay, or an oil rig under construction. I want to shift this asset to another asset. That is called as reclassification. Okay. So how will you do reclassification? What the standard says is, when you are doing reclassification, when will you do reclassification? First of all, once technical feasibility and commercial viability are demonstrable. you are going to do reclassification of this expenditure, this asset, okay, and you are going to consider it as part of another asset, that is a mine under construction or the oil rig under construction. You are going to shift the cost, the asset to the another asset. Now a question arises, should we check it for impairment? What the standard says is, when you are doing reclassification, check the asset for impairment, complete the impairment checking, and then after recognizing any impairment loss, you can shift the asset amount to the other asset which is being developed, okay. So that is what the standard has to say about reclassification. Now impairment, this standard requires us to check for impairment if you are showing exploration and evaluation expenditure as an asset. So when there are circumstances, events which suggest that there might be some impairment. What is the impairment? When you find that when the management estimates that the carrying amount of the asset is more than recoverable amount. That means by either using the asset or by selling the asset, whatever we may get, that is called as the recoverable amount. If the carrying amount of the asset is more than the recoverable amount, that means we are not going to recover the entire carrying amount. In such case, we call the asset as impaired. So when there are indications of impairment, we have to check exploration and evaluation assets for impairment, and we have to do impairment testing also. And the situations which give doubt, which give we can say an indication of impairment, are prescribed in the standard. But how to measure impairment loss, how to present impairment loss, how to disclose impairment loss, the entire methodology is contained in INDAS 36, which deals with impairment of assets. Okay, so we are going to refer to INDAS 36 for learning how to measure, present and disclose impairment losses. But this standard contains the situations where you have to check for impairment. Apart from that, when you are doing impairment, how to club it with cash generating units for the purpose of checking for impairment. Can you consider it along with cash generating units for the purpose of checking impairment is what is prescribed by the standard. Let us see. Now, facts and circumstances which suggest impairment. Exploration rights have expired. Our rights to explore have expired. So it is now meaningless to show that it is an asset. Okay. Next. No material plan or budget for further exploration in the area. The management has not approved a material budget or does not have a plan to conduct further exploration and evaluation. That means the management has come to a point where they say it is enough. That means we want to stop this activity because it's a failure. It's an indication that you have to start checking the exploration evaluation asset for we can say impairment. Failed efforts in that area. We have dug many wells and we have found that there is no oil at all. So automatically there will be a doubt that whatever expenditure we are showing as an asset may not be recoverable at all. Sufficient availability of data to indicate impairment. So if you have sufficient data which says that there is impairment, you have to start checking impairment. See, the question is very simple here. I have started incurring some expenditure on exploration and evaluation during the current year. By the end of the year, the activity has not come to an end. I am not able to say that the activity has concluded. In such case, I will just carry it forward as an asset. In future, once the activity comes to an end, I know whether it is successful or failure, whether the activity is a success or a failure. If it is a failure, then I am debited to P&L account. It's a loss for me. If it is success, then I will go to the next stage, that is development, and this expenditure will be shifted. Okay. So you have to check the asset for impairment if there are any indications of impairment. So if you have incurred any expenditure during the year, you have capitalized it as a part of an asset, there are situations which suggest that there is an impairment, you have to check for impairment this asset, and then a part of the asset might have to be debited to P&L account as an impairment loss. Okay. Now let us see the disclosures. Before we go to disclosures, there is one very important point which you have to discuss. Now, when you are checking for impairment, the standard specifically talks about a particular issue. The cash generating unit to which exploration and evaluation asset is allocated for impairment testing shall not be larger than an operating segment under INDAS 108. See, in INDAS 36 you will come to learn that sometimes there are certain assets which cannot generate cash independently. In such cases, we cannot check those assets independently for impairment. If an asset is not independently able to generate cash, in such cases we group that asset with other assets and we try to find out the smallest group of assets which can generate cash independently of other assets. If you have related goodwill or other intangible assets, then we consider both of them together to check for impairment. So similarly, exploration and evaluation expenditure have to be considered along with the cash generating unit to evaluate whether the asset is impaired. See, evaluation and exploration expenditure is incapable of generating cash independently. So it has to be clubbed with a cash generating unit which can generate cash independently, and then you check the assets of the cash generating unit and this exploration, evaluation, expenditure together for impairment. Okay, but when you are allocating, you see to it that the CGU to which this exploration, evaluation, expenditure is allocated is not larger than an operating segment under Ind AS 108. Okay, so you cannot select a very big segment. The biggest you can select is a segment which is an operating segment under Ind AS 108. Okay. Now, what are the disclosures? Provide information that helps the users to identify and understand the amounts relating to exploration and evaluation activity which has been shown in the P&L account. So you have to describe and you have to help users to understand the amounts which have been shown either in the P&L account or in the balance sheet relating to this exploration and evaluation activity. Okay, and then disclose accounting policy for the expenditure treated as an asset. So what is the accounting policy you are following? Which expenditure you are capitalizing, which expenditure you are debiting to P&L account? What is your accounting policy? You have to specifically disclose. Disclose the amount of assets and liabilities, expense and income from such activities. So from this activity of exploration and evaluation, if there are any assets, liabilities, incomes and expenses, you have to disclose them. Okay. Treat them as separate class of assets and make disclosures consistent with Ind AS 16, Ind AS 38. So we are not going to club them with property, plant and equipment or other intangible assets. We'll either call them as intangible exploration and evaluation assets, tangible exploration and evaluation assets, disclosures which are required by Ind AS 16, Ind AS 38, similar disclosure will be required. But you are not going to club them with property, plant and equipment, you are not going to club them with intangible assets. You have to disclose them separately. But disclosures which are required for a PPE, similar disclosures are required even for tangible exploration and evaluation assets. Whatever disclosures are required as per Ind AS 38 for intangible assets, similar disclosures are required even for exploration and evaluation intangible assets. Okay. Next, change of accounting policy. Can I change my accounting policy? The standard has a clear answer for this. If information is more relevant and reliable, policy can be changed. That means if you can demonstrate the fact that because of change in accounting policy, information becomes more relevant and reliable, then definitely yes, you can change the accounting policy as well. Next, two methods to be which are generally followed. We'll discuss them to understand better. Successful efforts method, full cost method. Let us take an example. Let us suppose there is a country which has been divided into 4 fields. You can say 4 geographical areas where there are some expected reserves, where the government expects that there are some reserves of minerals, oil, gas, etc. They have divided a particular geographical location into area A, B, C and D, let us say. Okay, it's a very big geographical location. It is divided into 4 areas A, B, C, D. Now, what is successful efforts method, full cost method? Now, whatever expenditure is incurred on exploration and evaluation on each field, field A, field B, field C, field D, is going to be accounted separately. If the activity is successful, it will be capitalized and will form part of cost of asset which is under construction. Okay. If it is failure, then we are going to debit everything to the profit and loss account. That is called as successful efforts method. So if the effort is successful, we will capitalize. If it is a failure, then we are going to debit it to P&L account. So expenditure on exploration, acquisition, development, if it is successful, we will capitalize and then we are going to depreciate it based on production from that oil field. Okay. If it is failure, we are going to debit to P&L account. That is a very simple method, successful efforts method. That means exploration and evaluation expenditure in field A will not have any impact on the asset which is shown for field B or field C or field D. That means you are going to treat them separately. If one is successful, it will be capitalized. If the other is failure, expenditure on exploration evaluation in that particular field will be debited to P&L. Okay. Full cost method. Same example. There are 4 regions A, B, C, D within a big geographical area. Now, what the company will do is they will take it as that the entire region will be considered as a cost pool, and the total cost of exploration, evaluation on all the 4 fields will be capitalized. And in future, we are going to check it for impairment, and we are going to we can say depreciate it to P&L account. In full cost method, what will happen is there will be greater deferral of cost, and in future there will be increased depreciation charge. That is the impact of full cost method. So companies generally follow these methods for the purpose of accounting for such kinds of expenditure. Okay. So this was